Welcome to Joy Tank. Today on the show, our guest is Ryan Steen. If you'd like to reach out to Ryan for any of your mortgage needs, visit capitalmortgagesource.com.
Stupid ways to do it, or the less good ways to do it, or the more stressful ways to do it, because
Right.
there's bad loans and bad deals and good loans and good deals and kind of everything in between. And
No bad loan for the right deal.
there you go. I like that. That's good. Today on Joy Tank, we got Ryan Steen, a wise and affluent mortgage lender who is super awesome, does a lot of investments, friend of mine, awesome guy. We're bringing in the expert to talk about lending, different kinds of deals, different kinds of loans, and more importantly, different kinds of goals, and the best and bad ways to get to those goals. First off, what is your perspective on good debt versus bad debt primarily as a conventional mortgage lender?
So, I guess I kind of view debt. Obviously, debt is just leverage, right? So, bad debt, I guess we could start with bad debt. Bad debt is, I look at that as interest rates that are too high, or the property doesn't support the interest rate. It's always what is your return, right? Like, what is your return on the property? If I have a 12% interest rate and I can still net positive on a rental property, then that's still good debt, right? If it's paying itself, that's kind of where I look at. I look at the investment. Does it cover its own expenses, including the interest on the mortgage? And if it covers all of that, then somebody else is paying your mortgage, right? And you're not paying it. Now, obviously, there's worst case scenarios for everything, right?
That's true.
Bad renters. People have all kinds of bad stories with bad renters, and but I think that's just part of the game, and in the end, it just comes out okay. So I don't really think that there's, you can get like private loans that might be bad, right? But in general, it's hard to get a bad loan right now if the property is supporting the loan, right?
So to you, this is more about the deal, which sort of, this makes sense to me. Assets and liabilities. An asset makes you money, a liability loses you money. So if I was going to go buy a single family home, and with the rental market that it was in, even if with whatever down payment I had to get into that, like conventional loan, if the rental market that it's in gives me, if I'm only netting $20, right? If I'm able to pay the principal, interest, taxes, and insurance, BITI, and then I have a couple $100 for maintenance, and there's only $100 left over. That's where I think, for me, it gets kind of like blurry. I've met investors who own dozens of houses. This general contractor I used to sub for, he had like 25 single family houses, and he told me that, and I was like, oh, that's so cool, man. And he's like, yeah, well, that makes one of us that thinks it's cool, I was like, he was super stressed out, started telling me about all this stuff, how he just basically, it was just kind of a retirement plan that he was a slave to, right, for like 20 years, because he had all these single family homes that didn't really net enough to make it a good business, right?
Right. And I think that comes down to goals, right? Like he was saying, okay, so he was stressed out for 20 years, right? But then he owned 25 single family homes.
Yeah.
So, cost benefit analysis, I guess. And
what
is your level of what is your level of being able to tolerate some of those things, right? Some people are good at it. Some people, you could buy properties that only support having someone else manage those properties for you to take the stress off of it. So I think that's some of the question.
That makes sense. What do you think? I guess yeah, that's true. Different goals and different thresholds. The guy was going to be probably cashing in on $12 million, $6 to $12 million kind of, right? It's not bad after 20 years, but a huge grind to get there.
Right. But
My
if,
goals, I think, are more oriented around, it would be, I think the long term is the biggest priority. I want to have, but also like early retirement. Like I'm always thinking like, what's the quickest way I can get out of my day job and have more power over my time, with passive rental income. But I also am really interested in having generational things for my kids. Nathaniel, would love to let him speak on his goals. I think he's actually weirdly aligned. Like we're thinking of, we have like different paths to similar long-term goals, which is super interesting. So I'd love to talk kind of pro con and like the different ways to get there, easier and harder.
yeah, no, that makes sense. And I think no matter how you look at it, things aren't fast. Like we want everything fast, and in general, it's just not going to be fast. Um, it takes time.
Yeah, that's true. Nathaniel, please lay out your strategy for real estate wealth and generational wealth and your plan. Give it to us.
Yes. The large overview is to have a trust ultimately that the kids manage, and ultimately to have potentially at least 4 properties in that trust. And the way I want to build it, this is my plan, is I currently have a mortgage on the home that I live in. I'm paying, it's a 30-year fixed, but I'm paying it as if it's a 15. So it'll be paid off by 2034. And so I'll own that outright. And then I want to buy a second home, move into that second home, and rent this one out. I think by the time 2035 rolls around, I'll be able to rent this one out for about $3,000 a month. And I would apply that directly to the mortgage on the second home, which I'm living in, which I'm also applying my income towards that mortgage. So it kind of creates this positive net snowball. And at some point, buy a third home, which would be just kind of the only intent on that third home would to be passive income that goes towards paying off that third home's mortgage. So just purchase it and rent it out immediately. And then the ultimate goal would to be pay off all 3 of those homes, buy like a ranch or farm style home with like 10 acres or something like that on it, live on that, rent out the other 3, and use that in my retirement years on the farm as a hobby farm and as a rental venue for weddings and stuff like that. So that's kind of my long-term goal. So that pushes basically owning a small farm, 3 homes by the time I'm like 65, basically, and have that all wrapped into a trust. And then the kids, I have 3 kids. So instead of it being like kid 1, you get house A, kid 2, you get house B, they all manage the trust together. And if they want to sell any of those homes or purchase more properties, they all 3 have to agree to it. Ryan, I can tell by your speechlessness that you're just amazed at the foolproofness of my plan.
Oh, no, I mean, I was just trying to walk through that and figure out, does that make, if you were, I guess my question is always, why wait and not move faster? Do you find a security, or do you find there is more of a foolproofness to that plan in some ways. And what is your appeal to that, rather than saying, I'm just going to acquire as many properties as I can now, and if I can save up enough for a down payment, I'm going to buy a property, as long as it's paying for itself, or maybe positive net just a little bit. And then, because you're talking about having your third house by what what you were 34 for the second house, and then what would the next house be?
Purchasing of the third house was 10 years after that. So around before 2050 would kind of be the goal.
Okay. So if you look at, say, 20 to 25 years out, right? How many properties could you have acquired in that time period that are going to appreciate, paying for themselves, appreciating, and then at some point you could liquidate and consolidate with lower mortgages, but you could move, you could put the focus on acquiring, and then you have the option to decide, do I want to um do I want to buy more property? Do I want to sell property and pay off some of the property I have? Because during that time period, you also experience tax benefits. And if you want to borrow from your rentals, it's free money because somebody else is paying off that mortgage, but that's non-taxable income because it's debt. So there's an advantage in borrowing from assets for other purposes. So rather than paying off your house, right, you can borrow against that. It's like it's income that's coming in. It's just a savings account or however. But then you also have tax benefits from owning property. So you're lowering your tax burden, which is enabling you to save more quickly.
Yeah, that's good news. And I think Tyler's complaint about my strategy was that he thought it would take too long. So it's good to hear you say that, not in a disagreement with Tyler, but to say, yeah, your plan could potentially be more aggressive, and that's still realistic. And I think between Tyler and I am definitely the one who errs on the side of caution, precaution, and double caution, and potentially some post caution. So I'm all about, be safe as possible, this most solid plan. There is the fear that I have bad renters, and things go sideways and I'm on the hook for too many mortgages because too many people just decided to not pay rent. But that fear is kind of hypothetical and plausible. It doesn't really strike a chord with like fear in my heart as being a realistic fear. That feels very much like we could cross those bridges of problems when we get there. That kind of mindset doesn't really keep me from potentially expanding the horizon and buying the properties faster. Tyler, do you have kind of a specific number in your mind that you could throw at Ryan for how many properties and at what rate you'd purchase them?
Sure. I did want to say on that note, though, because I think a lot of people have fear and concern going into managing tenants and wondering, well, probably the most valid position is like, what if COVID happens again, right? Like in Oregon and in a number of states, there was a moratorium on evictions. So if somebody didn't pay rent, you literally could not evict them for that. You had to use a different type of eviction notice. And then eventually it became where there weren't any eviction notices you could issue, almost at all. It didn't last super duper long, but that was a really bad situation. However, that was pretty unprecedented, and I don't think if COVID happened again, I don't think society would react quite the same way as it did last time. Outside of that, like year-long moratorium that like the state levied down, like the full moratorium, outside of COVID, being a landlord has always had there's bumps and speed bumps on the road with like tenants and things, but at the end of the day, like it's a trade. And just as you, Nathaniel, like as somebody who's trained in construction, if somebody was not skilled in construction was told, hey, we need to like frame this out and then like put a roof on it in the next 5 days, it's pretty reasonable. If they didn't know how to manage construction or do construction, that would be an incredibly daunting, nigh impossible feeling, full of variables, kind of a task to like assess. But if you're a landlord and you've been landlording, it's a skill set. And so if it's just like, kind of like, cool, I have 60 days to like very safely financially get somebody back in this unit, like turn it over and vet people, put out a couple ads and vet people and put people in. To me, that's a process, and 60 days is like super comfy. That's like so much time to like get in a good tenant that I've picked and I know how to, because I'm familiar with all those processes, right? Just like you're familiar with the processes, the tools and the construction, job site management, all that stuff. For me, it's just a sequence of processes. And now, could I get a tenant in 2 weeks? That's a little bit more stressful, but it's possible. But that's like some long days, you know. And so I think when as soon as you get comfortable with those processes, anybody who gets comfortable with those processes gets comfortable with those timelines. And also, you know, there's also the art of budgeting, even when you're using you're pulling your net and you managing it like a business. So like if you have a rental income, like Ryan was just talking about, if you have rental incomes or you're running them like businesses. So if like your house is renting for $2,000 and your PITI is $1,000, there's $1,000 of net, but not really, because you have to set aside for maintenance, right? You also might want to set aside, when you first get a house, I personally believe in setting aside 100% of all net earnings, so that you can put that in and create an emergency fund, just like you would do for your normal, it's like your normal bills. It's like, well, what if I lose my job? It's like, well, that's why we have 2 months of money, that like your cost of living for a month, we got 2 envelopes of those full of money that we stick right here, just in case a recession happens or whatever, right? Or we need a transition. In the same way, you immediately build up a 60-day emergency fund. You kind of have a couple months of somebody's rent effectively kind of set aside for yourself before you start to dip into that money. That way you can kind of run it as a business safely. So if you get a bad, awful tenant, not only have you been setting aside maintenance money every month, but you've been setting aside, you have an emergency fund established. And it becomes a much safer kind of a business to run. That only really looks safe to somebody who just simply hasn't done any of those processes before, which, you know, there's just going to be a little bit of a learning curve, and that's life with any kind of a trade. So yeah, just some thoughts on that, because I think I just hear that from a lot of people. They're like, well, we could buy another house, but like, I don't know, like managing people and tenants, and that just sounds really scary to people. It's really not very scary. So, you know, just 2 cents.
Right. Now, I think that's a great point. I mean, when you're unfamiliar with it, it feels scary, and the more you do it, the more comfortable you're going to become in it. But it's a business, like you said, it's a business that you can approach like a business. Very few people are going to start a business with all of the capital that they need. So it's just deciding, how safe is this business compared to other businesses? And what are the potential profits from this business versus another business someone may be interested in?
I mean, if you think about it from like, you know, every parent tells their kid at some point, like, well, you know, if you go to college, listen, there's always going to be medical. And you're communicating to the kid, right? Like, there's always going to be sick people. And so being a doctor, like, you're never going to run out of work. And I think the same is true for real estate. You know, robots are never going to replace landlords. I mean, BlackRock might get into that business a little. I don't know, whatever. Anyway, there's people are always going to need a place to live, you know? So there's always going to be like a market for that. If anything, I think it might become, I have a conspiracy that it's going to become exceptionally hard to buy real estate over the course of our lifetime. And by the time our kids are our age, I think there will be a very, very small market, and it's going to become like England, where everybody's just in a flat and, you know, has a little condo or something, you know? So I don't know, we'll see. Nathaniel passed the buck to me and said, what was my plan? And for me, it's just really weird, because the more I think about it, the more it gets less specific, because I just want net passive income, and I don't want it to be a pain in the butt as much as possible. And so I'm really interested in like cap rates, where it's like, how much bang for my buck am I getting with this? Like, I would rather have a bunch of fourplexes. I'd rather have 10 fourplexes than 40 single family homes,
Yes.
because it would be significantly easier, like probably 70% easier, my guess, to manage, like literally. And it would make more money. Overall, I think, when you look at, because there's shared maintenance costs and all these things. So I'm starting to get really interested in, like, I manage commercial real estate for a living now, and I'm getting really interested in that realm of things, which works a little differently. So it's also a little intimidating because the loans work a little differently, and the deals are structured kind of differently. They're more sold as businesses, whereas when you're buying a house from someone, that's like where they grew up and stuff, or it's something they worked really hard to buy and they've lived there. So there's all these emotions attached to it. And if you're buying, a fiveplex from a guy, it's like a completely different vibe because you're basically buying a business that he's been running, you know? So I don't even know how to quantify. I'm just kind of looking for deals in high cap rates and trying to find ways to structure things that aren't stressful, that don't force me to flip, because I don't want to flip, because I just think that's just another job. It's another kind of way of making money, which is cool, but it's not my goal. I want to find ways to, like, keep it forever with a long-term amortized mortgage or a long carry or something. So I don't know. I'm sure there's probably good ways and bad ways to do it. I'd be really curious to your thoughts on ways to speed up that process,
Yeah. So Ryan, I want to piggyback on that question and ask, I think for us, we've kind of talked about a little bit some people don't have the capital that they really should before they start a business. And there are also some people that I know that are happy as clams, just renting properties and never have an intent to buy. But for some people that Tyler's been talking to recently, and kind of some people that are like-minded, similarly to Tyler and myself, the concept of at least just having the home that you and your family live in and a second one as passive income seems like it's becoming popular with people between their, like, 30s and 40s as being a pretty viable option for income. What would you say would be some of the good ways to go about that? By purchasing a second home, what are some key goals that you want to hit, or timelines you want to look for, or interest rates, and 10% down, 20% down?
Nathaniel, let's point the percentage down thing at him, because we were initially, we threw this whole thing out. We were going to make this whole episode about trying to answer that one very question, and the math got so intolerable. We shifted gears.
There's too many variables.
There's a lot of variables. So generally speaking, though, I want to grab that question out of there for you, Ryan. Generally speaking, how big of a deal should should mortgage insurance be? In other words, that if whoever's listening doesn't know, mortgage insurance being the thing that you have to pay until you own 20% equity. So if you have less than 20% down, you get a mortgage insurance fee on there. How big of a deal is that fee, and should it be bothersome to people? Should it be in your priorities at all to avoid?
I tend to, and this is from personal experience, I have never really considered a whole lot about a mortgage other than, can I get it and can I afford it? When I was buying houses when I was younger, I knew little about real estate. I've been doing mortgages for almost 10 years. I was in real estate for a couple years before that. I was a builder before that. But I bought my first house pretty young. I couldn't even tell you if I had mortgage insurance. I don't even remember. I just knew I could afford it, and I was buying a house. And so I had a little bit of a different attitude towards that. And so I think your first home doesn't matter that much. Like, can you afford the payment? Well, then you're buying something that's yours. Now, you don't want to buy over your head. You also don't want to buy the nicest house in the worst neighborhood. There are things that you do that make sense. And I think that those things are way more important than the mortgage insurance. First, the way I look at it, starting out, like a first-time home buyer, look for something that you can put a little bit of sweat equity into. plan on living there for a couple years and then moving on to taking the equity that you've got in your sweat equity and any appreciation, and then being able to take that and move it into the next house. And if you do that, it's often been said you do that 2 or 3 times, or three to four times maybe now, but then you own a home, right? You could almost own your home. A lot of people I'm seeing now are just starting to do that, but then they'll move out because with a primary, so like you said, you have mortgage insurance with less than 20% down. If you have excellent credit, mortgage insurance becomes much less of an issue. It can be pretty nominal. If you have 10% down, your mortgage insurance is probably going to be in the, like, depending on the price of the home, but it might be $50-$60 a month. And so that 50, nothing. I mean, that's going out to eat now, right? I mean,
Yeah.
So I think that,
it's like 2 Starbucks coffees.
Yeah, 2 Starbucks. Yes. So, I mean, I think that is, I think it again comes down to all of those variables. Like, there's so many variables. One of them is is going to be your credit score, right? I mean, that's going to affect your mortgage insurance, but then you still have FHA loans, which have the same mortgage insurance no matter what your credit score is. Yeah. So I think it's more about lining out what your goals are and then seeing, does this purchase align with my goals?
So if my goal was, I want to create as much wealth as possible in my lifetime, what would you say would be a great way to do that? But then also, maybe first start with, what would be a bad way to do that people think is a good way? Like, what's a common, you see what I'm saying?
I mean, that again is such a difficult question, because I think ultimately the bad way to do it is to take on debt that you can't service, right? You take debt that you can't pay. You lose your house. Those are like all the worst case scenarios. But I mean, if you're really, it kind of depends on, back to what you were saying, that guy with 25 single family homes. He decided to suffer for a time, right? So I guess some of it is, how much are you willing to sacrifice in the short term for your long-term goals? And then that changes the method in which you approach that end, right? Because if you're wanting to move more quickly, it's probably more suffering. If you're willing to move slow, I mean, I think Nathaniel's a good example. Like, his plan is slower, but it's going to be relatively painless and probably not very inconvenient for him. But I think if you want to move faster, you're going to introduce a little bit more risk or a little bit more inconvenience in that experience. Maybe not very much, though, if you still buying right, you're right. Buying the right properties is always going to be the answer to every real estate question.
Yeah, that's true. Well, I mean, my mind goes there too, because it's like, well, it just depends. And I think that's true, because if my whole metric is what can I afford, and also, like, what's good debt, so what is paying for itself and putting money in my pocket, and the more, the higher the percentage over, the better. So if it's paying for itself and there's still 30% of its income is available, that's great. Whether it's something that makes $10,000 a month, or whether it's something that only makes $1,000 a month, if that percentage is like in the green, that's great. And so I would like to collect those. If I hypothetically, I guess, that guy who has all those 25 single family homes, who, by the way, that was 15 years ago. He is done. He's sold them, and he's happy, and nobody ever hangs out with him because he's busy having margaritas on the beach or whatever. He's not around town anymore. He moved out of Sweet Home. But hypothetically, I'm not opposed to even what he was doing, except he was talking about, man, he was, verbalizing mortgages that were, and rentals that were making, literally $100 over the PITI. Like really, like no, like he had
Not
a
enough.
handful of houses that were $100 over the PITI. So like he's like, I don't even have money for maintenance. You
Right.
know, like he's literally just out of pocket buying paint out of his salary to go like paint for the turnover and buy the
Right.
carpet and stuff, right? I'm like, oh man, but that's not a great example of how real estate investing is scary and evil. It's a great example of how there's some great deals out there and some really not great deals out there.
But then again, you're saying that that guy's done now.
But he's happy.
So,
That's the true. So it's true. You're right. There was just pain and suffering in the short term, I suppose.
I mean, if you want to work 80 hours a week at your job, you're going to get ahead faster, right? So I think, I mean,
Yeah. Yeah.
it's just what do you want, right? Like what do you want and how much time do you have to sacrifice? Time and, time and do you have, I mean, honestly, if you have expendable income, putting it into your rentals is not a bad way to use it, because if you're paying for your rentals, those are all tax deductions. So you're basically improving your properties and writing off the expenses. And if you're using your income for that, then you're not paying taxes on those certain, you know what I mean? Like there's tax advantages there. I'm not a CPA.
No, for sure.
So,
No.
but there are
But
there
it's
are
true.
those advantages, right? And
Yeah.
so as interest rates have climbed up, we've actually even seen investors are actually more anxious to buy when interest rates are high sometimes, I think, because they realize that if they can get a property that's cash flowing now, they can refinance later. So they know it only
Oh, and
gets
it's going to be even better later when
it
the interest
only
rates are low.
gets
Yeah.
better. Yep.
Because if it cash flows at 7.5%, it's really cash flowing kind of worst case scenario as far as we can tell. So,
Exactly. Right. Well, it's not going to get worse, right?
mhm.
Rents aren't going down, and mortgage rate,
No.
once you're in a fixed mortgage rate, you're done, right? So your rate's not getting any worse. It's gonna stay there.
I think that's what gets me so excited about like having tenants and buying and holding for long term. I am friends with this like 75-year-old Mennonite property manager uh out of Corvallis. He's super sweet and we had lunch and I was like, man, how was the housing crash for you? How was like '08,
Right.
and he was like, yeah, man, I had contracting buddies begging for work and who were driving to Portland just to find a job. I had most of my real estate broker friends quit or froze their license. I think it was great for me. He was like, he was like, I'm running rentals. I had homeowners entering the rental pool. So I mean, my vetting, I got to get pickier. I got better tenants basically to pick from. Everybody still paid their rent. I mean, it was great. I was like, dude. But when you talk to guys who are flipping homes, their business went upside down
Right.
right then and there. You know what I mean? So I don't know. I get excited about long-term buy and hold. I'm really fascinated by this concept of like pain and effectiveness kind of being connected. So hypothetically, what you're telling me is it possible that Nathaniel and I have exactly the same goals and plan for the most part, but totally different? We've turned the dial on speed at a different way because I want to buy like a property. I want to buy like 2 properties a year, and he wants to
Right.
buy like a property every 5 years. But effectively, we're doing the same thing.
Yes, his tolerance is just less. Now I think, and then I think that's where you have to find that balance. Like Nathaniel has to ask himself that question, like, am I really just taking longer than I need to? Is there a level that I can go faster without really increasing the pain?
But I'm also like getting ulcers low key over here renting real estate. So
So there's that balance, right? It is
Yeah.
finding that scenario. What is, that would be my question to Nathaniel. It's like, could you turn it up just a little bit?
Nathaniel, what would be your hesitation? Like,
Uh,
and any answer's okay.
if somebody like Ryan, who's been in this game for longer and is a mortgage lender, knows construction, done real estate, my hesitation would be if he told me your plan is too aggressive, slow it down. So that would be my only hesitation. My plan is built around the plan that I could put in place by with my experience, which is just the one mortgage I have, a plan in my head that goes, yeah, this plan is pretty infallible. Like it's so steady and it's so slow that I don't really see anything disrupting it. So it's actually great news for Ryan to be like, bro, you could just do it faster. Like it's totally feasible. I do, without derailing the whole conversation, I wanted to jump back and ask Ryan a question because obviously we're talking about kind of all what you want to do is based on what your end goals are. But I do want to pull out potentially some sage wisdom here from you, Ryan, on if you owned 25 properties and you sold all of those 25 properties within a couple of years, like the guy that Tyler's talking about, wouldn't you miss out on a ton of future income, not only from the rental passive income you can have from those, but also from the amount you would have to pay in taxes by selling all of those homes?
Yes. I mean, I would never think of selling them all. I mean, I think if you have 25 rentals and now all of a sudden that you own them free and clear and say they average out at $2,000 a month, well, now you're netting, you're making 50K a month on your rental income. So why would you want to take that? I don't think anybody would realistically want to take that hit, that tax hit, as opposed to just taking the steady income.
Yeah. And that was my thought when I heard that. I do understand that if your goal is to have zero stress in your life and you put the numbers together and you realize if I sell all 25 of these homes, I'll have enough to last me till I'm 97 drinking Mai Tais on the beach in Mexico, and that's what you want to do, then I do totally get it. And I also understand that other people's threshold for starting companies and purchasing properties is zero. They want to work for the man from 9 to 5 and they want to rent a place, and that's all they want to do. And they think that anything beyond that is crazy or risky or ultimately just not worth it. So I get that, that's kind of one end of the spectrum. And then there's also the guy who buys 25, holds on to them for long enough that he can sell them and make some profit and drink Mai Tais on the beach. That's kind of another end of the spectrum. And I think both Tyler and I's vision is somewhere in the middle, where you're buying properties, acquiring these assets, making sure they're cash flowing, and ending up, I believe, Tyler, you also want to have a trust, right? So that it's all managed, all the properties are managed within that trust, right?
A living trust with my children as beneficiaries and potentially as trustees. Yeah.
Yeah.
That's the plan.
That's our end goal. Ultimately, I have the steps to that end goal is purchasing 3 homes that'll be rentals, and then the 4th home that would be in the trust would be the one I'd live in, have that as a hobby farm. That'd be where I'd die and get buried, and could have passive income through that by having it as a wedding venue, potentially, if I got enough energy when I'm 65. But yeah, so thank you for answering that question, because that kind of blew my mind a little bit. I would imagine that the taxes you'd pay on selling 25 homes, even if they're not all within the same year, you got 2 calendar years, that's a crap ton of taxes.
Yeah, and there's no reason. Yeah, I mean, I think the beauty of rentals is the way that you can use it. I mean, you could borrow against all 25 houses and have a huge sum of money that was just borrowed, right? So now you've got all that money.
When you say borrow against, you mean like a home equity line of credit?
Yeah, you could cash out, refinance them. you know.
Okay, sure. I tend to really be anti HELOC outside of some pretty specific situations like addition on your own home, things like that.
Right.
Depending on
Yeah,
your
I
equity,
mean more
like I
for
think that can be
investment,
good, but
but for investment properties, I tend to think that there's just, and then I think there's a train of thought that you just keep them leveraged. Like you just
mm,
keep those rentals leveraged. You as soon as you have enough equity to cash out, you cash out to buy another property. And that thing keeps cash flowing for you. And then you're into another one. So
I think a cash out refinance is a great idea, but I think you definitely, if for like rental income only properties while you're in your 20 years of building stage, but
right,
I definitely think you play the interest rate world. Like if I had 10 units, I in two on two different properties, like a couple fiveplexes or something, and I had yeah, I think it just depends on. I don't know if I bought them at 7%. As soon as it dips down to 4, I'm ready. You know what I
well, I
mean?
mean, if it dips down, if you've got 10 rentals and all of a sudden you're netting an extra 150 on each one of those because
Sure.
it drops a 0.5%, it starts to make some more, you start thinking about it much more quickly.
I guess that's true. How
But
often
I
can
mean, you
you?
don't rush into that. I mean, but you do consider it.
Well, I mean, you're doing math at that point. Like
E-
that's your business is the
Exactly.
math, and that's how you run it well. Yeah, no, that's interesting. I think cash out finances are like a really fascinating tool, and we've talked about those before. We had an episode on the Burr method.
Oh
we
yeah,
like
it's a
I'm
great.
very pro cash out refinance as a tool that has a place to be used. A HELOC I think is a much more specific use case in which it can actually be helpful and not just danger town for people.
Right.
But it is true. I mean, yeah, that guy who sold his homes, I think that was kind of dumb. I think there's 10 other cool things you could have done
Yeah.
instead of just put them on the MLS, you know? Like there's a lot of cool things he could have did. I don't know why he did it, but yeah, it's neither here nor there. What's cool is you have so many options, like when you actually have assets in your hands, you know.
Right.
Um, I guess, you know, what is moving so let me think. What is moving too fast? Does that just mean things you can't? I mean, sometimes it's not. I like your metric of like, can you afford it is great. For me, if I'm buying something I know is going to be a rental, it's just kind of risk assessment at that point, though, isn't it? Like, well, there's going to be barely enough to like pay the maintenance, or man, it's an apartment complex, but it needs a lot of work, and it's going to be
Right.
me putting that work into it, and it's going to be a stretch to afford all the materials necessary for this 20plex with the money that it's currently making, and so this is going to be a difficult one or one I need to try and restructure or something, right? That isn't quite as cut and dry as can I afford it.
Right.
So like I
Um,
guess how fast is too fast? What if I'm trying to, let's say, aggressively buy commercial real estate every year? When what are the signs that a guy's going too fast, getting in over his head?
I mean, it's like any other business. I mean, I think you have to just kind of evaluate it in the same way. I don't think, you know, I think it's a personal risk tolerance again, because if I move too fast, I'm going to get my hand slapped. and and am I willing to have my hand slapped? Is that a risk that I'm willing to take? I lose a property? Do I wreck my credit? Um, I think that if you approach it like a business, some businesses don't work out because they weren't well planned, and that's the only way you're going to really. You just have to have a good team. I think I was thinking about that because I've seen people that maybe don't have the experience, but they've got. I work with people like this all the time. They've got me to help them with the mortgage side of things. They have a real estate agent that really knows the real estate market well. And they also have a property manager that knows how to manage properties. And so that real estate agent is hunting for the deal for them. And then when they find the deal, the property manager's like, oh yeah, those are undervalued. I can get you another $300 a month for those properties. You know, we just need to get them, and then we can raise the rents. And then, and then you're getting, the nice thing about real estate is everybody's expertise kind of comes for free because everybody gets paid along the way, right?
Sure.
Everybody gets paid. I get paid if I help people achieve the goals that they want. If they're not achieving the goals they want, they're not coming back to me. They're not going to be happy. And they're not going to buy real estate. So the more I can do to help people be successful, the more business they want to do, which is better for everybody. Same thing with a realtor. He's out there. He wants happy people. He wants to find them the deal. And so if he can find them the deal, then they come back to him. And if you have a good property manager, you just know you don't have to worry about it. Because like you said earlier, well, I don't have a problem. 60 days, I'm going to have no problem putting a new tenant in full, and you can confirm that. You can give confidence in those things.
It's true. It's just another process. What do you
I think in the risk assessment, having that team in place makes a big difference because you don't have to be an expert.
What is something that that's kind of like, what do the mortgage lenders like sigh and guffaw and laugh about how like the plebeians, just if they could just understand this one thing, like what's the inner thing that really frustrates you? You know what I mean? As a lender specifically, like, man, if people just understood this, they'd be so much more successful at this.
I mean, I think the biggest thing I think people have a hard time understanding in this business, because it was hard for me to understand, is underwriting is underwriting, right? When you get a loan underwritten, we just have to meet certain guidelines. And so if you don't have documentation, if you can't source funds, just different basic things like that, we always think there's a way around stuff. Underwriters aren't like that. So it's hard to get around what they need. And so I think I experienced that more than anything else. And then, in general, like for first-time home buyers and stuff like that, is there's not really first-time home buyer programs. There's a couple little things out there. There's nothing big that's first-time home buyer. And I'm surprised that people still think they need 20% down to buy a home. So there's just like some of those things. You can buy your first home with as little as 3%, so, and you can buy, like if Nathaniel wanted to go buy a house, he could convert his home into a rental and go buy a house with as little as 5% down. So,
geez,
you don't need, and I have a lot of people that do that. They get their 5%, they convert their home into a rental, and they go buy something else.
And you were saying, Ryan, I could even potentially take a loan on the equity that I have in my home, and that could be my 5%.
Exactly.
Right? If I was going a hyperdrive speed, I could basically be looking for properties right away. Yeah. Because we purchased in 2019. So I've got, coming up on 5 years of equity in it. And then obviously the market went way up, has come down in my area, about $120,000 over the last couple of years. From
you could buy 3 homes.
Yeah. Yep. So would you recommend, Ryan, for kind of answering the question for people looking to buy just the second home? Obviously there's to some extent what the overall goal is, but we'll say that's the overall goal. And then we'll say that their tolerance is the tolerance level of a guy who's got a wife and a couple of kids. He's got to work the 9 to 5. So he's already got all that going on. He's got Little League on Saturday and whatnot. So he's, got a full life. Does it make sense to, obviously you said have a good credit score is pretty key, except for the FHA loan. Have, like Tyler mentioned, 2 to 3 months of kind of a safety net that's squirreled away, that we're not including that as the down payment, and then come up with the down payment and basically just lock that bad boy in pretty much as soon as you can? Is that kind of the, I don't want to twist your arm for an answer, but is that kind of your, would you recommend that method? You're saying if you could tolerate it, just go ahead and get that second home and
If
make it work?
if you're comfortable with it, yes. That's my thought is if that's your comfort, if you are comfortable with it, then push it as fast as possible, because I only see real estate appreciating. At some point, maybe we see it depreciate, but even in 2008, you're over in Bend, right? That was a
Yep.
little, Bend got hit hard. I'm over in Corvallis. Corvallis didn't really get hit like other places did. So I think you have to be aware of the market that you're in and the swings that you may experience. But if you're not in it for the short term, then it's not really that, it doesn't matter as much.
Okay, cool.
Yeah.
I think that answers the question for Tyler and I, because obviously there's still a lot of nuance and there's still a lot of people that it wouldn't necessarily make sense for, depending on their specific situation. But that the overall general answer being, yeah, go ahead and, make sure that you're living below your means, get some money set aside for your rainy day fund, get some money put up for probably kind of the safe way that people feel comfortable with, is saving up some money for that down payment, and then just go for it.
Well, sort of. I want to jump in here. I think that there's a hidden difficulty because there's all the metrics you just said 100%. Like, can I afford the new house in this town that's, a 30-minute better drive to everything, right? Okay, so I can afford it and I have 5% down, or, I want to, or I have enough equity I can take out, I can do a cash out refinance and I can get a little bit, and then there you go. So, and and there's the house. I've found a good deal. And am I in a positive rental market that's stable for long-term rentals? You are. All of us are. And Oregon, for the most part, Western and Central is like a really great place for stability for long-term rentals. Not everybody lives in a good, stable long-term rental space. Like maybe you live in Klamath Falls. You know what I'm saying? we don't. And so there's that. All those boxes are checked. So that you can rent out the house behind, like that you're in, and that you can fix up and or just inhabit the one in front of you. I guess the one caveat is look at all those tools behind Nathaniel, and Ryan's a builder, and I'm a general contractor. Like we are probably, I'm going to be attracted to something that has a broken window and smelly carpets inside.
Right.
And if there's any way I can get it with as much finish problems, specifically like so that I can still get a loan on it, like as many finish problems there are is great. Like 70s flooring is great, pink walls are great, because it just all impacts the value ultimately. So I'm getting a discount when I see problems like that. And I think the big problem really logistically for people is just getting into that house and then renting out the one behind you, that also kind of being a new process you're not used to. And I think that, it like when you're talking about house hacking, if you're buying a fourplex as a business, it's different. But if you got to move into the thing that you're into, your asset that you're buying, that becomes kind of like a whole rigmarole you got to do with your family. You might move into mom and dad's for a couple of weeks while you like put new carpets in, and then you're like trying to figure out how to put a tenant in behind you. It's like a lot. I think that might be the hardest part about house hacking.
Yes, I agree, because I didn't house hack because I didn't start young enough. And by the time I realized I should be house hacking, I had a well-established family, and my wife was like, "No, we're not moving every 2 years."
You're like, but honey, look at this crappy little threeplex I got.
Exactly.
Doesn't it look great?
With that being said, my biggest recommendation for young people starting out is to buy a duplex. That's it. You can buy a duplex with FHA. FHA will let you buy a duplex with 3.5% down.
Whoa. Is that just residential? So does that apply to tri and quadplexes as well?
It does, but it's difficult. They have a self-sufficiency rule on 3 units and 4 units. And that means that, like, I think I'll have to brush up on it because I don't look at it all the time, but I believe it's 75% of the rents have to cover the PITI. It's pretty hard for that to happen.
That would be great. Yeah.
That would be an
And I would
incredible deal.
imagine the average
Yeah.
client you have walking in your door, Ryan, is not saying, "Hey, I want to buy a home. I'm a first-time home buyer. I'm also looking at a triplex."
Right. Yeah. I mean, honestly, we don't get there. It's strange, but we don't get a lot of. I don't get a lot of triplex. A lot of duplexes, but not as many triplex and fourplexes. It's just not as common.
Here's another little sequence of questions. Well, I know we're slowly running low on time, but I would love to. I just want to gang bust you with this. Construction loans for those who are savvy with construction and familiar with construction, or at least a little bit. Like, let's just like I've never done a construction loan. How does that work? So let's say I get a great deal on a lot, and I go, you know what? I talked to building and planning, and I can put a threeplex here. Or I can put a duplex here. The duplexes are kind of popular, and I just kind of go, you know what? Maybe I'll build one. How does that process work? How awful is it?
It's not the easiest. I mean, because generally, I mean, if you have a contractor that you can work with that's done it before, it helps a lot. But it's doable. I mean,
let's say I got the contractor and it's a spec home. I got the design all figured out, or it's even one he's done before. How does the schedule of the money, like, is it a payment schedule kind of a thing? When do you start paying the premiums
So there's a lot of different options. I mean, there's so many options, but in general, a lot of times you'll pay interest only until you roll into a permanent financing. So you may pay interest only on your balance until you roll into a permanent financing loan.
Is that because they need to kind of like assess it once it's complete?
I mean, you're going to have an appraisal ahead of time. So there's going to be a pre-appraisal. And that's how they determine whether they're going to lend you the money or not. And then after that appraisal, you'll have a final appraisal too. I'm working on one right now for somebody that's a fourplex. And so they're hoping to come into it with almost zero money out of pocket.
How does that work?
They own the lot. They own the lot, and I will keep you posted, but we're hoping to get them in with almost zero money out of pocket. And it's a $1.2 million build. But the appraised value is almost 2 million.
What are they building?
Fourplex.
Wow,
3,000 square foot units.
That's an amazing equity. Build for 1.2 and then it appraises at 2.
Yeah.
That's great.
That's what they're hoping.
That's wild.
So it's out there. It can be had. It's just again, that worked out. The best deals are finding a house with a lot that you can separate. That's just it.
Out of curiosity, and this would work out fine. Let's say I negotiate a seller financing deal on some blank land that's buildable. Would a bank see that note and feel like sort of second position, or would they be perfectly fine with giving you a construction loan on that? Or do I not mention to the bank that I have a seller financing?
Sometimes, I mean, you're going to have to, because you're going to have to show it, right?
Well, it's going to be visible.
I mean, there are some things where you try not to talk about, but that's one where they're going to like, well, do you own it outright? They're going to ask you point blank.
Well, I would record it at title, so it's going to be a visible
right,
thing.
you're going to have it recorded.
Yeah.
So, I mean, you're not going to have any equity, so you're going to need a down payment. The advantage is when you come in, say you buy a house, you split the lot off, sell the house, end up with a free lot. Now you've got $100,000 or $150,000 in equity, and you want to build a $300,000 house. You're coming in with 30%.
So if your parent handed you a blank lot, its value is the equity you've got. I mean, you have it.
That's your equity. Yep. So you're bringing it. If it's a $400,000 build, with the lot included. So if it's a $400,000 project, including the lot, and you own the lot, you're coming in with 25%.
Let's say I want $1 million, or this deal you're working on, right? It's like $1 million build. And so that's the loan amount that you're requesting. What's the interest only payment on that thing?
I mean, this one's going to be like a 12% interest probably, because it's a new build.
Is that normal?
On loans like that, yes.
Yeah, these
I
days,
mean,
sure.
it's an investment property, new build. So
Okay, you're getting the
they're high,
word.
those are high risk loans,
Yeah,
right? But they're happy. I mean, these investors that I work with a lot, I mean, they're happy to take interest only higher interest rates, interest only loans to have capital to do more. I think that comes from experience. They're like, oh, I don't care what the interest rate is. How much cash can I get out of this property? So how much
yeah.
money can I have to leverage into something else?
But then when you get it appraised, so you finish that building and now it's appraised at 2 million. Does that loan get kind of restructured and it's not
Yes.
7%, not 12?
No, it gets restructured as a conventional loan at that point.
Okay, and then you're paying a lower interest rate and it's normal and it's not interest only and
Yeah.
gotcha. So that's
And
how
some,
the banks keep themselves safe during the development process, basically, by
yes,
having you just pay them interest.
but sometimes you can pay that payment out of, sometimes you can get in with no payments even because it'll be financed into the loan. It just kind of depends on the product. There's a lot of
Gotcha.
so you can actually get more than you need. If there's enough equity, you might get more than you need and have a slush fund to pay your payments while you're building.
Oh, I see. Interesting. I
Yeah.
like it.
It
Cool.
depends. There's a lot of different ways. I mean, there are really in the last few years we've opened up a lot of avenues for investors. Because like one of the easiest loans we have now is a DSCR, which is a debt service coverage loan. Basically, they pull your credit, verify that you have the funds, do an appraisal on the house, and as long as your PITI, principal, interest, taxes, and insurance, is covered by the rent, it's done. That's the loan.
Wow. Wow.
No income for you, just does the property cash flow. Does it
What
cover its
is
rent?
there a standardized down payment or interest rate on that kind of loan?
Those are actually not bad interest rates because investment properties through like conventional I priced one the other day. I think, well, these guys are not a good example because they had like 40%, they had like 50% equity in an investment cash out. They're going to be at like 6 and 5/8.
Okay.
But I can get the DSCR loan for someone with high credit um in the high sixes. So they're not bad. They cost just a little bit more. You'll have a little more origination fee with it, but it doesn't matter if you make money. It doesn't matter. There's no qualification for the borrower for the most part, other than credit and
And the advantage of that is if you have great credit and you have some down payment saved up, you could buy a large income producing commercial property and not have a fantastic looking personal income necessarily at all because the DSCR loan isn't even going to look at that. It's like, well, whatever.
right.
We're looking at your credit, and do you have $50,000 to pay the origination fees on this, the down payment, and then congratulations. Here's a 10plex or whatever.
Yeah. Now the commercial loans get completely different though. That's
Oh,
the
right.
problem.
So it's
Anytime you
five
bump up
units, right?
above 4 units, so
Right.
5 units and above, it becomes a whole different animal, right? And then it becomes more. They're gonna want you to have a little bit of experience, probably. Some of them you can get away without it, but you're gonna need probably some kind of experience, reserves. But then they're looking at the property and how does it cash flow.
But for a normal person who doesn't have a lot of experience with that, they could buy a duplex or a
A
triplex,
duplex. Yep.
right?
Duplexes are very, yep.
Yeah, that's cool. I like it. Nathaniel, any other thoughts before we let Ryan
Yeah,
sleep?
kind of to bring it back down to our original question. The one question I have, Ryan, is what are the pros and cons of buying a second home and moving into that home while renting out the first versus pros and cons of buying a second home just as a rental home and not moving? You keep your first home, you just buy the second one.
So really the catch is the down payment. In Oregon, we're looking at 400, 350, let's just say 350. You're not going to find much under 350 in our area. From Sweet Home to Corvallis, I mean, 350 is kind of the baseline.
He lives in Bend, so add 100,000 onto
So
that.
add
There's
$100,000, right?
I
So
took Tyler Homes, and the least expensive one was in Bend was 599,000. Granted, I was looking for 3 bedrooms, 2 baths. But for that's kind of a pretty standard size home for kind of guys like Tyler and I who have a couple kids. So 3 bedrooms, 2 baths, nothing. The least expensive one in Bend was 599,000.
I mean, at the current moment, there's going to be
So-
deals come and go, but yeah.
single family home investment property, you can get a bit. There are some that you can do 15% down payment, but most people are doing 20%. So $600,000, you have to come up with $120,000, or you come up with 5%, which is $30,000.
Jeez,
So
that's
there's
easy.
there's the reasoning. That's it in a nutshell. Like, most people are going to have a really hard time saving up enough money for that first investment property.
Got it. So if you keep your first home as a rental and move into the second home, you're saying to streamline it, or what makes the most sense is you take that equity from your first home and use that equity as your down payment on the second home that you're going to live in.
Right, because you only need 5% down.
Gotcha.
So you
Okay,
might
cool.
not even have to pull equity out of your house.
Yeah, so that makes sense. So I think, Tyler, that if there's one answer we can give people who have been kind of pondering this, the answer to the question is you're going to move. If you want to have a rental property and you want
Yeah.
to have a home you're going to live in, you need to move. So you're going to
Well,
rent
well,
out the one.
that would be how to do it pretty comfortably, and it's the cheapest, and it would be a highly effective way, because now you're also getting to move into places, make them nice yourself, enjoy it for a year, right? So you could buy a new house every 2 to 3 years and kind of like comfortably fix up the one that you're in and then jump into the next one, constantly turning the ones behind you into rentals, only paying 5% to get into the next one, fix it up, and building a ton of equity as you go along the way.
I
Like,
mean, I've seen people do it about twice, and that seems to be most people's max for whatever.
Because of the amount of time and energy and money it takes to put the sweat equity into it is just exhausting.
I think that, and I just also think moving, you're probably catching people, young families, that do maybe
moving sucks.
young marrieds do the first one and they're like, yeah, we got this. And then they got a couple kids and they do it again. And then all of a sudden they're like, I'm not doing that again.
Yeah. The more passengers, the more, if you're changing school districts or moving towns,
Exactly.
there's a lot of strings attached. Yeah. Or roots that you're pulling up.
Yeah, it gets more and more difficult.
Yeah, that makes sense.
So then if you are in a position where, like, I got my kids, I know this is the school, you might get more refined and kind of go, this is the school district I want. This is my price point for what I can afford in this area if I'm in a more expensive area or whatever. So you might end up waiting. But then, I mean, the bottom line is, if you have your buy box ready, if you know, cool, I want something under this price, 3-bed, 2-bath in this district. And if I see something that pops up, I already have 5% for that price range ready to go, and I'm going to jump on it. And maybe it takes 5 years to see that appear, or maybe it takes 1 year. But like that would be logically, if you didn't want to do the leapfrogging thing, that would be what you would want to do, right? You'd want to have your house hacking single family home buy box ready to go for whether that's next year or 10 years from now.
Yeah. And the other advantage, and maybe the other reason people stop doing it eventually, is because by the time you're ready to buy that third or fourth home, that first home's ready for a cash out. And it actually probably has enough equity to buy the next rental property.
Yeah.
So that's another way to look at it too, is those properties are gaining equity because you're paying down the mortgage and the time value of appreciation. So by the time, now your first house, I can do a cash out and get enough money. We've saved money and I can do a cash out and we can buy our next rental property now. Right. And then the next thing you know, the next house is ready to do that. So then you're kind of on this snowball roller coaster of being able to cash out and draw money from properties and get, I mean, real estate is a beautiful tool in that way. It's just like compound interest. I mean, it's the same concept. It's just once you get some
That's so
momentum.
weird. They're like savings accounts. If when you're
They
doing
are. They're
that
for
snowball
safe.
thing, it's like, hey, hand me all the money back that I've been paying you, and I'm gonna buy another house with it, and then just
Exactly.
refresh my mortgage. You know, that's wild.
Yep.
Yeah, wow, I dig it. Nathaniel, how do you, how are we feeling?
I appreciate your time, Ryan. I think this has probably been the most helpful Joy Take podcast that we've recorded so far. I would think, Tyler. What do you think?
I agree.
Yeah. So
Nice.
thank you for your time. Any closing thoughts you have, Ryan? Words of advice, sage wisdom?
No, I mean, I just think take everything to heart. I mean, I think in my experience, and I haven't executed as well as I would like to, but most average people that I know that gain wealth, it's through real estate. I mean, that's the general, it's available to everyone. It's just what sacrifices are you willing to make, I guess. But it's one of the only tools that I know that is available to just anybody, really. I mean, if you know, there's no limit. So
I dig it. Ryan, thanks for being on the show, man. We'll let everybody know how to get a hold of you. Everybody who's listening, this should be the person that you have write up your next loan for you. You've been great, bro.
thanks, man. Yeah, no, it was fun. So
Good. See ya.
see ya.
Bye.
Today on the show, our guest is Ryan Steen. If you'd like to reach out to Ryan for any of your mortgage needs, visit capitalmortgagesource.com.